If you have a mortgage or are looking to go out and get one, you will have almost certainly noticed what's been going on with interest rates. Over the past 12 months, the RBA has increased its cash rate by some 4 percentage points, taking the official cash rate to 4.1%. But of course, no one borrows at the cash rate, you borrow at the mortgage rate. So mortgage rates have also increased, and our borrowing costs are significant. And this is particularly a problem for people who are on fixed rates and are looking to shift on to variable rates in the very near future. However, now some relief might be on the horizon. At its latest meeting, the RBA decided to not increase its cash rate and left the cash rate unchanged at 4.1%. This obviously is good news for borrowers. However, of course, further rate hikes could be on the horizon. The RBA, for example, specifically stated, some further tightening of monetary policy may be required to ensure that inflation returns to target in a reasonable timeframe. But that will depend upon how the economy and inflation evolve. In essence, the RBA was not ultra hawkish in its statement. The RBA indicated that maybe additional tightening will be required, but maybe it won't be. That's ultimately good news for borrowers. It suggests that maybe we won't have that many more rate hikes. Maybe in the not too distant future, we might in fact have some rate cuts as the economy and inflation start going back down toward target. Now, of course, the main reason for the RBA's decision here was what's going on with inflation. And you can see a lot of this in the latest monthly CPI reading. In the latest monthly CPI reading, headline CPI inflation was 5.6%. Now that is still well above target of 2 to 3%, but it is far down on the prior reading of 6.8%, a significant improvement. However, things aren't quite as good if we look at core inflation. So for example, core CPI inflation was 6.4%, again significantly above target, but it too was slightly lower than the prior reading of 6.5%. This suggests that inflation might be going in the right direction. We're not quite at the target for inflation, but we are heading there. If we look at the components of inflation, we're seeing some things continue to be quite strong inflation-wise, some things going back down. So for example, one of the things that was causing inflation to go down was automotive fuel. That had decreased, hence why we saw this reduction in magnitude in headline CPI inflation. Now that of course is good, that can feed into core inflation as well. After all, when people go and fill up their car at the petrol station, they start to notice inflation even more. So for example, if automotive fuel is now less expensive, people might notice inflation a little bit less, so demand wage increases a little bit less than it otherwise do. It's only going to be incremental, but it still is positive. Furthermore, if automotive fuel isn't pushing up costs for companies, well, they have less likelihood of passing that cost on to consumers. That is, there's going to be less price pressure overall when automotive fuel is not continuing to spiral upwards. However, on the other hand, some things that had increased significantly over the past 12 months. These include housing, such as rents, food and non-alcoholic beverages, and things such as furnishings and equipment and the like. So if we focus on rents, for example, rents have increased strongly over the past 12 months, but in many cases they haven't increased any more than inflation, and they have to some extent been recovering from the pandemic lows. So we can notice during the pandemic, the rents actually decreased, and this means that rents had been recovering for a large part. So think of it this way, say a stock goes down 50% in value, well it now needs to double to go back to where it was. That is, your future price appreciation needs to be even higher than the amount that it fell by, which also translates into rents. So if rents fell by 5%, well they now need to increase by even more than 5% just to be back where they were. Hence why we see some rent inflation. And rent inflation overall hasn't been any worse really than core CPI inflation. And as a result, while people oftentimes like to demonize landlords, it's not entirely clear that the data actually backs this up in any way. However, granted, there are still supply shortages in many in-demand areas. If we look at things such as food and alcoholic beverages, well, to some extent, those are going to be impacted by random fluctuations. And those random fluctuations include what is happening with fuel and what is happening with labor. But if the labor market starts to show some progress, if, for example, it's easier to get access to employees, then some of those areas might show a little bit less inflation. But again, it's not universally positive here. For example, the significant increase in the minimum wage and the award wage could easily feed through into increases in food costs. So there could still be some future pressure on those. So overall, we can see some reasons why the RBA decided to pause at this meeting. We can see inflation heading in the right direction. The RBA also reports that the labor market is a little bit less tight than it was. The RBA also indicates that the economy appears to be slowing down a little bit, although it has been relatively robust. Hence why the RBA decided to pause at its most recent meeting. Now, whether the RBA increases rates in the future, well, that of course will depend upon future data. The RBA specifically indicated it will depend upon future inflation data. But if inflation keeps going downwards, we are much less likely to see future rate hikes. But if inflation surprises on the upside, then future rate hikes could be a distinct possibility. And in any case, this is good news for everyone who's hoping that mortgage rates start to head back downwards during 2024. In any case, if you've got any thoughts about the RBA's decision, well, let me know that in the comments below. And otherwise, thanks a lot for tuning in. Don't forget to subscribe, and hopefully I see you next time as well.